Hi everyone, welcome back. Let's take a look at investing psychology. Buy low, sell high. Why is this simple concept so difficult to put into practice? Why are we tempted to buy when prices rise and sell when prices fall? The fact is, we, as humans, are in many ways wired to be unsuccessful in the stock market. Emotions surrounding the stock market usually link to fear and greed. Fear of losing money and being greedy for additional profits. While there is nothing wrong with wanting to lose less or wanting to gain more, the desire for either often propels us to make poor financial decisions. Investing psychology is impossible to cover in only a few minutes, so my goal here is to introduce two concepts: FOMO, or the fear of missing out, and loss aversion. Think of FOMO as a form of anxiety or stress caused by the feeling that you are missing out on something. Let's look at an example. On January 4th, the first trading day of 2021, GameStop shares opened at $19. On January 28th, shares peaked during intraday trading at $483. And then on January 29th, shares closed out the month at $325. GameStop shares soared as more people became willing to pay astronomically high prices to be a part of the hype. Amongst these people was a security guard who took out a $20,000 loan at 11% interest to get in on the action. He purchased shares at $234, but within 2 weeks, shares traded for about $50, representing a near 80% decline from the purchase price. It is unlikely this individual, and many others, would have bought GameStop at record levels had it not had the attention and enthusiasm surrounding it that it did. The link to this story is in the video notes. Next up is loss aversion, which is people's natural tendency to prefer avoiding a loss over obtaining an equal gain. Simply put, people tend to prefer not losing $5 over finding $5. In fact, studies show the pain of losing is psychologically about twice as powerful as the pleasure of gaining. The Corporate Finance Institute offers 4 examples of loss aversion in the stock market. They include investing in low-return, guaranteed investments instead of more promising ones with higher risk, not selling a stock even though your analysis of the business suggests it should be sold, selling a stock that has gone up slightly in price just to realize a gain even though it should be held much longer, and telling oneself that an investment is not a loss until it is realized, which is when the investment is sold. The first step to combating FOMO and loss aversion is being aware they exist and knowing you are unlikely immune to the emotional responses they cause. In summary, FOMO is a form of anxiety or stress caused by the feeling that you are missing out on something, and loss aversion is people's tendency to prefer avoiding a loss over an equivalent gain. Next time, we look into a few of the free resources you can use to research stocks. See you there.